Trump first came out. Oh, he's going to end the war. Cool. Okay. So the markets were all happy about ending the war. The next thing he started bombing Yemen, and then the Israel lobby helping him go after Iran. So there's going to be an Iranian war. So like on the one hand, the market was like, oh, cool, war with Ukraine's probably going to stop, and that looks like it might take place, and that's great. I'm always for ending wars. But at the same time, they're ramping up pressure to take out Iran. And that's, the irony here is that going after Iran is really just going after Russia through a different angle.
You're watching CapitalCosm. My name is Danny. It is August 19th, and my guests today are none other than the publishers of the Capitalist Exploits newsletter, my favorite newsletter, my newsletter of choice. It is Chris Macintosh and Brad McFadden. Guys, thank you so much for coming on the show.
Good to be back, Danny.
Thank you so much, Danny. Yes, great to be here.
Yeah, I mean, you guys are always a treasure trove of knowledge and insights, and I always feel like I get something out of you guys that's just like out of the mainstream that you don't normally get from YouTube commentary. So let's go ahead and kick it off with you here, Chris. Lots of stuff going on in the world, but for you right now, anything sticking out on your radar screen that the average investor should be most privy to right now?
Probably nothing that we haven't spoken about in the past. So I'll just sound like a broken record to some degree, but it's the fact that we have significant risk in two portions of the market. One being in the bond markets, and so that's sovereign debt in particular, but it translates all the way through into other corporate debt, just because of how debt gets priced in the markets. And then the other one, of course, is concentration of risk of capital in in the United States in general, and in particular in the Mag 7, and really in particular in NVIDIA. And so there's when your average, what I see as being a significant risk, Danny, is that many investors don't understand what they're invested into when they go down this road and they speak to their financial advisor. In many instances, they're getting put into mutual funds and ETFs, and those mutual funds and ETFs are buying these assets. You are almost certainly invested through a pension fund. You're almost certainly invested into the sovereign debt markets in your bond side of your portfolio. And then in your equity side of the portfolio, they will have put you into some version of an S&P 500 or a NASDAQ type structure. And while that might have been fine 15, 20 years ago, the concentration today within those, within the S&P 500 in particular, and the NASDAQ, is at, is at extremes. And so that's where I see significant risk, where, the old risk parity trade, the idea that you're in equities, and if equities don't do well, your bond position will do well, and vice versa. Today, that's actually where I see the greatest risk, is actually in those two, in that in that risk parity trade, just because of the way it's structured. So that's where, probably, again, nothing that we haven't spoken about in the past. It's just that those things now are, I would say, look, there are always little signs. You don't know what, the final straw that breaks the camel's back will be until it's happened. But you've got bond yields spiking in Spain in particular. Whether that translates into something broader, we don't know. But I think for me, it's like, that's not actually the right question to ask. The right question to always ask is, am I outside of the risk zone? And then you can actually watch these sorts of things dispassionately and go, oh, that's kind of interesting. Look, there's people blowing up, as opposed to, oh shit, is this me? So yeah.
Yeah, here's the Spanish 10-year yield that you just alluded to, Chris. I mean, this thing is blowing up, like you said. Could this lead to any sort of contagion, or is Spain not a big enough entity to create that domino effect? What do you think?
I think it did before, going back a few years with the pigs.
The pigs?
Yes. Well, if you think about the Asian crisis, the 1997 Asian crisis, that also started in a similar fashion. Now, if you scale this out over time, this is probably fairly insignificant. Okay, it's Yeah, there you go. Okay, so it's been higher before, not that long ago. It's more the sudden move that is problematic, but you can see there's been a significant shift all the way back from 2022. What is important to pay attention to is the general market, the general direction of travel. And the general direction of travel across bond markets is problematic. That's really all that one needs to know. People are going to spend a lot of time on the news bite items, to some degree what we're looking at now, and go, oh my gosh, this is happening. Oh my gosh, that's happening. A rational, intelligent investor doesn't get caught up in that. They are in the position where they've seen that ahead of time and they understand the direction of travel and they're not involved. If it's risky, they're not involved. Or if it's positive, hopefully they are involved. But again, those big long-term trends are much more easily identifiable than your short-term, oh, suddenly bond yields are spiking in Spain. You know, if you'd asked me 2 weeks ago, oh, bond yields going to spike in Spain, I'm like, I don't fucking know. But if you could have asked me 3-4 years ago, which direction are bond yields going to go globally, I could have told you where they're going to go, and we did. So that's really the important thing. And then the question is just, how do you allocate your portfolio? How do you position for what is both inevitable and potentially imminent?
Yeah, and then on the same note, you've also got you've got the Fed funds rate, which has been sticking around at the current level for quite a while now. But what you'll notice here, I've got the Fed funds rate here in yellow and the 10-year yield, U.S. 10-year yield, that is, in white. And you can kind of see them moving in tandem, as they should. And there's typically a little bit of a lead time between the 10-year yields movement and the Fed funds rate. The 10-year tends to move before the Fed funds rate, just based off of this chart. But what you'll notice here is that when we did get our cut this time last year, it says August of 2024, we began cutting rates all the way heading into late 2024, December 2024. And what did the 10-year yield do? The 10-year yield didn't even blink. It just stayed where it was. So Brad, Chris, whichever you guys want to take this, what does this mean when the 10-year is pretty much calling the bluff of the Fed funds rate, which corresponds to the shorter end part of the yield curve?
Well, I'd say that you have ultimately at some point the bond market decides, right? It's not that the Fed decides. The Fed issues the debt, but the market's got to buy it. And I mean, you could pull up, I don't know if I've got it somewhere, charts of foreign holdings of US Treasuries. And there's a significant issue there, right? And because a lot of the time your foreign holdings of US Treasuries are governmental organizations or central banks. And it's been a very clear, again, direction of travel. There's a very extremely clear direction of travel with respect to US sovereign debt being under-owned and sold off by foreign holdings, China in particular. And of course you would. Why would you? They're antagonizing you. They're sitting there telling you that you're naughty and we're going to bomb you and all that sort of stuff. I think we spoke about it last time we were on this podcast. We were talking about Lindsay. I've never seen a war. I don't love Graham talking about how he was going to bomb China. Or, well, what he said was he was going to do to China what they've just done to the Ayatollah if they don't play ball. Anyway, the point is, why would you, as a holder of US debt, if you were China, why would you hold US debt when you have that sort of thing going on? The answer is you wouldn't. So that direction of travel there, your traditional buyers of that debt have been exiting the market. And it's moving very much into the short-term end of the curve. And that's really just for liquidity purposes. So you have a lot of desire to own liquidity, but there's no desire to own longevity. No one wants to own the 30-year. And that's because there's a lack of trust. So that's the problem. There you go.
Yeah, so here it is. So you've got China here in pink. So this is a chart of the various countries holding U.S. Treasury debt. China's here in pink. You can see that decline happening now. You see an increase when it comes to the UK. I mean, they're buying more of our debt. And you also see a decline in Japan as well versus, let's say, 2022.
Well, in the back of my mind, I wouldn't say in the back of my mind, perhaps the forefront of my mind is the interest spend on the US government is about the same as the spend on defense, plus or minus. It's like, a little bit more in terms of bond yields rising, not too much more, than the interest expense becomes the most the high ticket item on the US budget in terms of expenditure. And then I think if you try and trace it back, what's the market telling us? Look at the price of gold. I know everyone goes on gold, but that's telling us something. It's not just gold. Now platinum's doing stuff. Other precious metals like rhodium is also giving us indication as well. Perhaps the final piece in the jigsaw puzzle would be energy prices. If we see energy prices start to move higher, which no one thinks they're going to. Everyone thinks they're so bearish on the price of oil and coal and so on and so forth. But we start getting oil above $80 a barrel. That's going to certainly help. Bond yields to go higher. Obviously, inflationary consequences of that. So that's what we're sort of watching for as such. But I think it's a foregone conclusion that yields are going to move materially higher. It's a case of when, not if. And goodness, that's an interesting outcome. What happens then when the interest expense on US debt is the highest expense that US government has got, or US Treasury's got?
Yeah. And you couple this with the fact that given Trump's recent comments about giving up on fiscal conservatism and pretty much putting all the chips on the table on growth, trying to grow our way out of it. I haven't seen many countries throughout history that have been successful taking that route. I mean, have you guys? I mean, is there precedence for anything like this in history where a country was just able to grow its way out of its sovereign debt crisis? Could it be done?
So the closest that we had was the UK, and their little calling card that bailed them out was the finding the oil in the North Sea. Excuse me. But the answer is no, and they'd reached, I think it was about 80% debt to GDP, something of that nature. And then they made a big find, and they're like, "Whoa, okay." It's like, looking under the sofa, and there's someone left their wallet there. So I guess there's always some possibility that something comes along that's extraordinary, that develops or generates an extreme amount of wealth that can bail you out. But does Uncle Sam have another uncle that's got some money somewhere? Not that we can see anywhere. So all investing is basically a matter of probability and then positioning, and so the probability is no, based on history.
We had the US shale revolution that sort of bailed the US out, you could argue. I mean, what would happen if it wasn't for the shale? And now there's signs that that's topping out. It's certainly, at best you're going to get consistent production, no growth. It's been very, very difficult to grow US shale now. So the question is like how quickly that declines. So
yeah, and then at the same time, Brad, you look at all these potentials for grid failures and electricity grid failures. You saw, speaking of Spain, we saw a grid failure happen earlier in the year, and you pile on.
There was Renewables Day in Europe, Danny.
Oh yeah, those are renewables. But the point remains,
they were just celebrating Renewables Day.
But look, I mean, you have all these AI projects coming on board, and AI is the narrative that's been holding the market up together and enabling the market to make new all-time highs vis-a-vis the Max 7. And then you couple it with the fact that they are heavily resource intensive, energy intensive. They may be able to find some way in the future to streamline and make things more efficient. But as things stand right now, they are heavily intensive. And as grids throughout the world begin to feel the pressure to accommodate these data centers, what happens when you start seeing more grid failures across the world? And in places like Texas, where they've written it into law that if they were to have another, not worldwide, statewide grid failure, the first places they would shut down is the data centers. So they would be the top of the food chain. If that happens, if the data centers become a huge liability for society, for these countries, all of a sudden, the narrative that's been holding the market together goes out the window. The Max 7, you look at them in a different way. I mean, wouldn't you say that would be the case, or no?
Capital rotates. You're right, and it doesn't take much to change that direction of travel when you're reaching periods of, the old trading, almost like a cliche is, rising price on declining volume, and so what you're getting is like smaller or less participants at the end of a market. Because you can have, let's take NVIDIA. What's it today? It was 4.7 trillion the other day. It's probably a bit more now. In any event, you can just have one trade that takes place at a significantly higher valuation. And now it's a $5 trillion company. But it's only one trade, right? It's not like there's another trillion has been added. In market cap, it's now priced as if that's the ultimate price. But that can happen on the way down. And what's risky is when it happens on the way down and you have such a belief that the entire market is going to go no direction but up. And that comes about as a consequence typically of a lack of, shall we say, sophisticated investors, which is why your retail is always the last to actually enter any market at size. And I've got this. I don't know if I can share this with you.
Danny, it's interesting when you look at NVIDIA. That's 65% of the Japanese stock market. It's market cap.
It is, and it's heavily reliant on the AI narrative. What happens if that AI narrative comes into question? Doesn't have to go away, but just loses its robustness.
True. But then you could also argue, okay, fine. Well, what does it take to double? What is for NVIDIA to double?
Right.
Forget its earnings. It's got to find 65% of the market cap of the Japanese stock market to double its price. Like, where's that come from? Like, you start to enter the realms of physics now.
$4.3 trillion.
Yeah, there we go.
Hey, Danny, can we do this? I was just trying to share.
Yeah.
There we go. This, my friends, is what you get when retail enters the market. So you can look up Amit here. Amit is a retail guy. He doesn't know shit. Bless his heart. The American dream is no longer owning a home with a 30-year fixed rate. The American dream now is owning a sizable portion in NVIDIA. NVIDIA being a metaphor for the stock market, particularly AI. That is what is growing over the next decade, not housing.
Yeah, there we go, Chris. That's it.
This, folks, is now, is this the top? I don't know, but these are the types of things that you see. Because here's the way the human brain works. It has to justify, it has to rationalize what it sees. Okay. So when we look at something, we go, that doesn't make sense. We still have to, like, if you're seeing it, you're like, but it is, right? So it's like, it's a dog with 5 legs, and you're like, but dogs have 4 legs. But then you look at it and you're like, but this sucker's got 5 legs. So like, your brain has to rationalize that. It has to understand why. And you go, okay, well, clearly there's dogs with 5 legs. So now maybe it came out of Chernobyl, but the point is, when you're looking at something like NVIDIA, people forget about metrics. They forget about anything rational. They go, it's a $4.7 trillion company. It is. And look, last year it was like a 3 trillion. So the direction of travel is up. And, so just there's a justification for everything that you see. And that's the way the human brain works. And now you have retail people coming in and they don't understand. They couldn't even tell you what a price to book or a price to sales or PE ratio is or cape rate. Like they don't know any of this stuff. They just look at a price and they've bought something for X and it's gone up. I mean, I had this conversation with my sister yesterday and she's like, she's, through her app in Dubai, she's bought some property, some like email property and this and that. She's like, this one's going up. I think it's good. I think I should buy some more. What do you think? And I'm, but so I could ask her, what's the PE ratio? What's the debt? And she would never clue. She doesn't know what I'm talking about. She just knows that the price has gone up or the price has gone down and therefore it's good or therefore it's bad. So these are very, very risky times. If you're invested into the S&P 500, you're basically invested into the most concentrated market we've had in decades. There's like 493 stocks, which have basically gone nowhere. And then there's 7 that have carried that index. And of the 7 that have carried the index, this one accounts for about 8-9% of the entire index. If the last trade goes from whatever it's at today, I don't know. I don't even follow it because it's meaningless to me. If that drops 10, 20, 30% and no buyers come in and pick it up, what happens to Amit?
Hey guys, quick break from the action. Have you heard about this forbidden crypto play? Imagine beating Wall Street at their own game with the world's 5th largest coin, that's Binance Coin. It's the powerhouse behind one of the fastest blockchains on Earth. And it's bigger than Solana, it's bigger than Doge, it's more useful than Bitcoin, it's deflationary, and it even pays yields. But here's the kicker. Most Americans can't buy it directly through their brokerage. Up until now, that is. Enter CEA Industries, that's BNC on the NASDAQ. It's the first ever U.S. public company mirroring MicroStrategy's Bitcoin strategy, except with Binance Coin as its core treasury asset. They've already poured over $500 million into this thing, giving you a one-click exposure to massive upside before ETFs and institutions pile on potentially. This is MicroStrategy 2.0 with even more potential. Binance Coin soared 25x in 5 years. So check it out. Talk to your advisor. Start your own due diligence on BNC on the NASDAQ today and front run the herd. Now back to the video. Amit's going to have a pretty bad day. He's not going to want to open his Robinhood account. Or Amit's going to sell it all.
I might suggest he might sell.
It's precarious.
And then he sells and everyone else sells. And next thing you're down 10, 20, 30%. Now, the kind of things that Brad and I buy, we can be up and down 20, 30%, but we know where we bought. We're not worried about it. So it's the type of buyer in the market today is increasingly of a retail-oriented mindset, and that is always dangerous.
Now, the stuff that you guys invest in through your portfolios, because you do have two separate portfolios. There is a dividend portfolio, and you also have a capital gains portfolio as well, targeting asymmetric trades. And in every video, I highly encourage my audience to consider joining Capital's Exploits Insider. I've been a member for 5 years, and I can't recommend it enough. And it was actually the newsletter that got me started into looking at these, these contra plays that you don't hear on mainstream. And so we have a special $1,000 discount down below by clicking on the link in the description or the pinned comment. Check it out, guys, if you're interested. But Chris and Brad, I mean, we just saw on two separate occasions over the last week or so. The first occasion was Trump meeting with Putin in Alaska. And then yesterday we saw Trump meeting with the European leaders. And as a result of both of those meetings, you're seeing a depressed oil price. Oil's beginning to sell off. Gold has lost a bit of a bid as well. Does this portend to, I mean, it appears that this portends to lower energy costs. Obviously, once conflict de-escalates, it has the opposite effect of when conflict escalates, which is inflation. In this case, it appears to be deflation. Is this what we're looking at, or are we so embedded within the cycles that there's really nothing that can stop something like this from transpiring?
Yeah, look, I think it's short-term noise, Danny. We don't need to have geopolitical conflict to understand the supply and demand dynamic within the energy space, for example, or many others. And so traders will work on the news. They'll look at the headlines. They'll see that Trump's doing this or Trump's doing that, and then the short-term moves. It's meaningless. It doesn't stop the direction of travel. It's not going to stop or change the dynamic of shale oil in the US declining in volume. That's been in place for some time. It's not going to change that. Trump coming out and making any politician making any statements isn't going to change that particular dynamic. With respect to geopolitical tensions, I mean, look, we could go back a few months back and go, okay, actually longer, when Trump first came out, he's going to end the war. Cool, okay. So the markets were happy about ending the war. The next thing he started bombing Yemen, and then the Israel lobby helping him go after Iran. So there's going to be an Iranian war. So like on the one hand, the market was like, oh, cool, war with Ukraine's probably going to stop, and that looks like it might take place, and that's great. I'm always for ending wars. But at the same time, they're ramping up pressure to take out Iran. And that's, the irony is that going after Iran is really just going after Russia through a different angle. And
through the
so,
Caspian Sea. Yeah, that's right.
Again, short-term noise, I don't think it changes direction of travel. Certainly with respect to the sectors that we own, it doesn't change the underlying supply and demand dynamics. We don't need to have geopolitical conflict in order to... Our positioning isn't because we're anticipating or have anticipated geopolitical conflict. We have anticipated it, but that's not the reason we own it. We own it because it has a supply-demand imbalance. It's extremely cheap, and we can buy those equities often with dividends payments that exceed anything else we can find in the market. So there's a whole host of reasons why we own them. It's got nothing to do with the fact Trump's making peace or not making peace, and so on and so forth.
Understood. Brad, I know you guys have some data you want to share about your dividend portfolio offering for people who are interested. Let's go ahead and pull that up and check out what you've got.
Yeah. Okay. So I'll just so we have just a quick one. We have a dividend portfolio which no one really pays too much attention to, and it sort of ticks away in the background. It's outperformed the All Country World Index. It's actually kept up with the S&P 500, strangely enough. And it's done so, and when I say kept up, over the last 5 years, it's performed exactly in line with it. But it's done so, strangely enough, with a very big exposure to energy and basic materials. So we've got about 44% exposure, probably 50% exposure to, say, commodities with a bias towards energy.
Mm-hmm.
Look at the All Country World Index. Its exposure to oil and gas is 2.73. I guess you add, basic materials, it's probably going to be about 3%, 3.5%, thereabouts. It's not much. So our biggest exposure is a least exposure in the All Country World Index, and our least exposure, which is technology. We do have a few of those, about 2%. Technology is however you define it in terms of the All Country World Index. So I guess add semiconductors, internet, computers, software all together, and you get what's that, 20, 30, about 30-odd%, isn't it, thereabouts? I know more than that, probably 35%. So yeah, that's where we see the value. And we're invested in things that just produce cash, things that you just you would not have heard of. In fact, most fund managers wouldn't have heard of. Now, if we look at the ETF DVY, which invests in high dividend yielding, so-called high dividend yielding stocks in the US, the usual suspects: Altria, Ford, Verizon, Edison. There's an ETF that invests just in high dividend yielding stocks ex-US. Surprise, surprise. Nestle, I never actually thought that was high dividend yielding anyway. Roche, HSBC, Shell. And then the usual suspects here, just as a reference point, the All Country World Index, that's the Magnificent Seven. That's your concentration. And so here's some of our sort of top holdings. When I say top, they're not, it's not like we have a massive holding in any one stock, but these are things you just have not heard of. And so we have a company called Bet Shemesh Engines. They do jet engines in Israel. Halawak Bank, that's banking in Kazakhstan. A little company called Archicom, which is real estate development in Poland. IRSA, which is commercial real estate in Argentina. We'll go through some of these soon. Glow Brands, cigarettes in Israel. There's one called Okeanis Eco Tankers, which is crude oil tankers in Norway. Kinetic Developments, coal mining in China. Costco International, it's shipping services in China. GR Engineering and mining engineering in Aussie. And then, can you believe it? A little Papua New Guinean banking company called Kina Securities, which is listed on the ASX. We go through little weird things. So, Spanish bond yields and what Trump does or doesn't do doesn't really interest us too much. Here's, quietly beneath the scenes, this is what these companies have been doing. Because this is one Archicom, it's one of the first investments we made. This is sort of early 2021 when the dividend portfolio got going. So the white line here is a total return. So it's dividends reinvested. The yellow line is the actual price index. Well, yeah, because it's indexed to 100. And people say, dividend investing is boring. It's like, well, yeah, maybe, but over like even a 5-year period, when you got 8% plus dividends and you're reinvesting those dividends, it does make a massive difference. So, you got a 220% return versus 130% return from the stock price. What else we got here? This is that jet engine company. We invested in that like a few years ago, and that took off. I know. It's like almost, if you see 974 there, 974, that's about 874%. I know, it's mind-boggling. This is a little savings bank or commercial bank, retail bank in Kazakhstan, which services all over the show, Georgia and what have you, so sort of Central Asia. And here's the power of dividends. Now, the stock price is up some 86% in that time. But if you reinvest in the dividends, you're looking at 215%. That's colossal. Yeah, just a boring little banking stock in Kazakhstan.
And that's, I feel like, is the biggest value proposition, or one of the biggest value propositions of Insider, Capital Exploits Insider. And it's because you guys find like all of these stocks and investment ideas and sectors that one would never even have on their radar screen, would never think of. I would have never thought of any of this. You really do go outside the box and offer so much alpha, for the readers. And I just wanted to make that clear for the audience. I mean, have you guys heard of any of these stocks? I mean,
no,
I would
no.
say 99.9% of the people watching have never heard of any of these stocks. But go ahead, Brad.
Yeah, we you're right there. We try and bring something very, very different to the table that the average wouldn't say the average investor, but the average fund manager would not have heard of. You listen to CNBC or Bloomberg, whatever. It's just jibber jabber about Meta or NVIDIA or whatever, but you never hear of this stuff. So this is an Argentinian stock, IRSA. I can't even pronounce the name. That's how much of a Philistine I am. But they've got commercial real estate, be it shopping malls, office space, be it resorts. This resort here is where Obama stayed when he was president. Anyway, I think he was president. Anyway, yeah, that's a Barilucci, Chris. That's where all the Nazis went after the Second World War. Yeah. So I mean, these were when we invested in these companies, our initial investments, the dividend yields were above 10%. A little bit less now. It's between 7% and 8%. But there we go. So okay, so it's pretty impressive. It's been 276% return on the stock price, and in dividends, you're getting 439. A tanker stock, boring as batshit, you may say. Well, yep. 316% return with dividends reinvested. And a little coal company producing boring black coal out of China called Kinetic Developments. Now, it's been about, well, you can see there, look, the returns are sort of mind-boggling, but that's the impact, folks, of dividend yields, I think this was like a 15%, 17% dividend yield when we first invested in it. A little bit less now. I think it's about 8 or 9. That's how, over time, that's how they compound. It's like, wow, who said dividend investing is boring, or buying these high dividend yielding companies? Costco International, bang, you can see there the massive gap opening up. That's shipping services. So they do bunkers, they do marine chandling services, marine paints, shipping agencies. Again, nothing rocket science here, but just producing cash. An engineering service company out of Australia. They manufacture mining plants. I think the last one here, to top it all off, it hasn't been one of the better performers for, but still, it's up almost 80% in that time. So this is called Kinner Securities. It's banking out of Papua New Guinea. Banking, securities trading, but mainly just good old-fashioned banking. So, well, look, these are sort of smaller cap companies. So bigger fund managers can't really invest in these things, but for smaller folks like ourselves, we're sort of small and nimble, we can invest in these, and it makes a lot of sense. So that's what we try and do, Danny. We try and get out there and find things that, I think I've stopped sharing, have I? Yeah.
Yep.
Find things that no one's really talking about, looking at, and that's where the value is.
Yeah, I mean, it's always interesting seeing what you guys have dug up. I don't know where you find this stuff, how you find this stuff, but it's always something novel. And you hate to sound like a broken record, but I just simply can't recommend Capital Exploits Insider enough. I mean, you guys have been on the ball for years now, certainly over the last 5 years since I've been a member. And so it's why I'm always excited to pitch our special $1,000 discount that you can get from watching this channel. We have that link again down below in the description, as well as the pinned comment. So, all right, guys, I think we've covered so many things. The whole swath of it, as it pertains to what's going on in the world, how the average investor can prepare themselves. Anything else you want to talk about or bring up before we sign off here? Chris, Brad?
Nothing I can think of right now. I think we covered, as you mentioned, most of what's important. just try and keep it simple, folks. It doesn't have to be complex. It shouldn't be complex.
Yeah,
All right.
it's quite funny, Denny. You ask, oh, so what have you been, what's the big thing you're looking at, Brad, and the markets right now, and so forth. And it's like, nothing really, Danny. I'm just looking beneath the covers and areas where no one else dares to look at these little things. So the last stock we saw there, a Papua New Guinean bank. Like, what's that got to do with Trump, Spanish bond yields, so on and so forth? So I'm just a good old fashioned boring fund manager looking for opportunity.
The way I look at you guys is kind of like you're my outsourced research team, right? So you guys are doing this for your full-time job, and for people who may not have the bandwidth and the capacity to do all this deep value research like you guys have, just subscribing to the newsletter, getting access to the portfolios, that's a very streamlined way for the average to level the playing field for the average investor, to kind of, if they are seeking alpha outside of the usual noise that you would hear from mainstream outlets like on CNBC and even a lot of YouTube content as well. It does tend to get a little bit repetitive at times too. So certainly a lot of novelty here. Gents, thank you so much for coming on. We'll have the link to your X account, Chris, at the bottom of the description down below, as well as a special link to our $1,000 discount. Be sure to take advantage of it. If you guys enjoyed this podcast, drop us a like and comment, go Chris, go Brad, go. And let me know what you guys thought. Did you agree? Did you disagree? Either way, let me know. I do, in fact, read the comments, and I will be replying to a number of comments. I can't reply to all of them, but I'll try to reply to a few of them. So let me know your thoughts down below. Subscribe to the channel so you don't miss an episode, and liking, subscribing, commenting, doing all that YouTube stuff certainly goes a long way in helping push this video in the algorithm. So if you'd like this message spread out to as many people as possible, if you'd like this channel to spread out and grow, a little bit certainly goes a long way. And so with all that said, thank you guys for watching, and I will catch you later. Bye.
Thanks, James.